Stop scrolling for a second, because something very unusual is happening in the precious metals market right now. Gold is making headlines, investors are piling in, and yet, silver is not moving the way it historically should. And that's exactly why the debate of silver versus gold in 2026 has suddenly exploded across the financial world. So here's the big question. Is silver about to explode higher, or is gold still the safer play in this new economic landscape? Today we're not guessing, and we're definitely not repeating old narratives. We're looking at fresh market data pulled today, March 5th, 2026, and breaking down exactly what's happening behind the scenes. We'll look at where gold and silver actually stand right now, what's really driving their prices, why the relationship between them looks so strange at the moment, and most importantly, what could happen next. Because if you're an investor, a trader, or someone simply trying to understand where the global financial system is heading, this is information you cannot afford to miss. So first, let's set the scene, because this market is absolutely extraordinary right now. Gold is trading today somewhere between $5,141 and $5,175 per ounce. Just pause for a second and think about that. 1 year ago, gold was sitting around $2,624 per ounce. That's a gain of roughly 77% in 12 months, one of the strongest one-year performances for gold in modern financial history. And it hit an all-time high of $5,595 on January 29th of this year. Silver, meanwhile, hit its own all-time high of $121.88 per ounce on that same exact date. Today it's trading around $89.95 per ounce, down from that peak, but still up more than 25% year-to-date on the futures market. Both metals have had a truly historic run. The question is, going forward, which one has more left in the tank? Let's start with gold, because gold is the one making all the headlines, and rightfully so. The forces behind gold's 77% surge are real and structural, not just speculative noise. Central banks around the world have been buying gold at a pace not seen in decades. JP Morgan, in their latest research, expects central bank and investor demand to average around 585 tons per quarter throughout 2026. That is enormous. Part of what's driving that buying is de-dollarization. Nations are actively trying to reduce their exposure to US dollar-denominated assets. Dollar-denominated holdings are increasingly seen as risky in light of sanctions, asset seizures, and geopolitical interventions. So countries are parking money in gold instead. That's a multi-year structural shift, not a trade. Then there's the geopolitical layer on top. Escalating US-Israel tensions with Iran have rattled global markets. When Dubai, which handled about 20% of global gold flows last year, saw air cargo disruption from the conflict, it triggered an immediate surge in physical demand from Asian buyers. India's domestic gold prices flipped from a $50 per ounce discount to full London parity in just 48 hours. That's how fast the physical market tightens when supply chains get disrupted. The Fed is another factor. Right now, 95.6% of market participants expect rates to hold steady at 3.50 to 3.75% at the March 18th meeting. But longer term, if rate cuts do materialize, that removes a key headwind for gold. Gold doesn't pay a yield, so it thrives when rates fall. Any pivot from the Fed would likely add significant fuel to gold's move higher. And there's something more unusual happening too. The DOJ served the Federal Reserve with grand jury subpoenas targeting Chair Powell in early January 2026. That kind of uncertainty around Fed independence has been pushing institutional money into gold as a hedge against financial system instability. Where does gold go from here? JP Morgan's base case is $5,055 per ounce by Q4 2026, rising toward $5,400 by end of 2027. The high-end bull case involves just 0.5% of foreign U.S. asset holdings shifting into gold, which alone, they say, would push prices toward $6,000 per ounce. And Jamie Dimon himself has publicly said that investing in gold is becoming rational for the first time in his career, with a personal upside target of $5,000 to $10,000 per ounce. So gold is clearly in a massive secular bull market. But now let's talk about silver, because the silver story might actually be more interesting for investors focused on percentage returns. Silver's 2025 performance was jaw-dropping. At the start of 2025, most analysts had a high-end target of around $37 per ounce. Silver closed the year above $76, nearly double what even the bulls expected, delivering a total return of over 160%, making it one of the best performing assets of the entire year. And it wasn't done. Silver went on to hit that all-time high of $121.88 in January 2026. Yes, it has pulled back since then, but the structural story behind silver has not changed one bit. Here's what makes silver unique, and arguably more compelling than gold for percentage gains. Silver is both a monetary metal and an industrial metal. Roughly 59% of total silver usage is industrial. That means silver's price doesn't just respond to fear and central bank buying. It also responds to the real economy, to technology, to clean energy build-out, and to AI infrastructure. Let's break those drivers down. The solar industry has been one of the most powerful forces driving silver demand. Every solar panel contains silver. As global solar capacity has expanded, silver consumption from that sector has been enormous. However, and this is a nuance worth paying close attention to, solar manufacturers are actively working to reduce the amount of silver per panel. Silver now accounts for an estimated 17 to 29% of PV module costs per watt, up sharply from just 3% in 2023. That cost pressure is real. Companies like Longi Green Energy and Jinko Solar are experimenting with copper-based alternatives. The Silver Institute projects solar silver demand to fall about 7% year over year in 2026, even as global solar capacity grows 15%. That is a headwind silver bulls need to watch and factor in honestly. But the shortfall from solar is being picked up elsewhere. Data centers powering AI infrastructure require silver in significant quantities. The EV sector is growing. Electronics and medical demand continue rising. And critically, the cumulative supply deficit for silver has been running for 5 straight years. From 2021 through 2025, the cumulative shortfall totaled close to 800 million ounces, roughly 25,000 tons of silver consumed beyond what was mined. In 2026, the Silver Institute projects the deficit to continue at around 67 million ounces, which would mark the 6th consecutive year the market has consumed more silver than it produced. Sprott Asset Management's John Ciampaglia put it plainly in their 2026 outlook: silver is scarce. Not all silver used in industrial processes is recovered. There is no large above-ground stockpile sitting idle. Once silver gets consumed in a solar panel or an electronics component, it's essentially gone. You're already seeing physical tightness emerge in the London market, with lease rates hitting record highs as physical metal flowed into New York vaults ahead of potential tariff concerns. Now here's the key metric professional traders use to compare these two metals: the gold to silver ratio. This tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged between 60 and 75 to 1. At its peak earlier in 2025, it hit 104 to 1, meaning silver was extraordinarily undervalued relative to gold. As silver surged, that ratio compressed and is now hovering around 57 to 1 based on today's prices. Historically, when the ratio is above its long-term average and then starts compressing, silver tends to dramatically outperform gold in percentage terms. We are watching exactly that dynamic play out right now. FX Empire analysts describe this as a structural repricing, not a speculative spike. Silver breaking decisively above its 40-year resistance at $50 per ounce in 2025 was a key technical event, one that suggests the metal has entered a new phase of price discovery entirely. Current technical support sits at $70 and then $55, while resistance stands at $94, $100, and then the all-time high zone between $117 and $120. Institutional interest in silver is also building in a way that wasn't there before. A Kitco News silver survey found that 57% of retail investors expect silver to trade above $100 per ounce in 2026. More importantly, institutional money is starting to show up. The iShares Silver Trust, ticker SLV, sits at a market cap of $42.73 billion today and has seen $1.75 billion in inflows over just the past month. That is serious money rotating into silver paper exposure. One report noted a single buyer in Utah looking to execute a $100 million silver purchase. These are the kinds of large-scale institutional moves that tend to show up before a broader public push into an asset class. What do the forecasters say? Bank of America's Michael Widmer has a silver target range of $135 to $309. Citi has published a target of $150. Gold Silver's Alan Hibbard sees $175 as a reasonable upside scenario. JP Morgan is more conservative at around $81 per ounce average, But even that model acknowledges significant upside risk if industrial demand holds and deficits persist. Scottsdale Bullion notes that current expert projections put silver's 2026 average near $97 per ounce. And given how consistently analysts underestimated silver over the past 2 years, the real number could be meaningfully higher. So which metal wins? Honestly, that's the wrong frame. Both metals are in a powerful secular bull market driven by real structural forces: de-dollarization, geopolitical risk, inflation, Fed uncertainty, and the clean energy and technology revolution. If you want stability, the proven institutional safe haven, and the metal that central banks are actively accumulating, gold is your answer. It's the anchor. It's the metal JP Morgan is recommending, that every major institution has a bullish price target on, and that has already proven it can go from $2,600 to $5,500 in a single year. But if you want asymmetric return potential, the metal that could deliver a higher percentage gain from current levels, the data right now points to silver. The gold to silver ratio has room to compress further. The structural supply deficit is worsening. Industrial demand from AI, EVs, and green energy continues to grow. And silver at $89 today is still 27% below its all-time high set just 5 weeks ago. If gold can nearly double in 12 months, there is a real argument that silver at current levels has the setup to outperform on a percentage basis. The risks are real, though. Silver is significantly more volatile. Margin liquidations can take it down 30% in days. We literally just watched that happen from $121 to $89 in a matter of weeks. Solar manufacturers cutting silver intensity is a genuine medium-term headwind. A stronger dollar or weaker global industrial output could slow the move. And technically, $70 support has to hold. If it breaks, the correction could deepen. But step back and look at the full picture. A 6-year supply deficit. A gold-silver ratio that has already shown it can collapse from 104 to 57 and likely has further to go. Industrial demand that ties silver directly to the biggest technological build-out of our lifetime. And institutional money that is only just starting to pay attention. Gold is the headline. Silver might be the opportunity. Watch the gold to silver ratio closely. Watch whether $70 holds as support on any further pullback. Watch the Fed on March 18th, and watch London lease rates. Because when physical silver gets scarce, the paper market eventually has to catch up. Both metals are telling us something important about where we are right now. That trust in traditional financial systems is eroding, that the dollar's global dominance is being questioned, and that hard assets are once again being taken seriously as the foundation of a resilient portfolio. Whether you own gold, silver, or both, the trend is your friend. And right now, that trend is pointing higher for precious metals. That's it for today's breakdown. If you found this useful, drop a like, subscribe, and let me know in the comments. Are you team gold, team silver, or do you hold both? I'll see you in the next one. Let's break it all down.